One Tuesday morning in September 2008, Americans woke up and $19 trillion of their money had silently vanished overnight. Shocked, a bank that survived 2 world wars, the Great Depression, and 9/11, collapsed in a single weekend. 158 years. Over in 48 hours. 8 million jobs destroyed. 4 million homes taken. Families who did everything right lost everything overnight. Angry, but here's what'll make your blood boil. The men who caused this disaster got billion-dollar bailouts and 0 jail time. How does the richest country on earth destroy itself from the inside? It starts with a lie. A beautiful, profitable American lie. This is the story of greed, stupidity, and the biggest financial crime in modern history. Pull up a chair. It gets insane. Curious? To understand 2008, you need to go back to 2001. America just got hit twice. The dot-com crash and 9/11, back to back. The Federal Reserve had one cure for a dying economy. Make borrowing money so cheap it's basically free. Rates dropped to 1%, almost zero. When borrowing is almost free, people borrow. A lot. Banks suddenly had oceans of cash to lend, and they needed customers fast. Owning a home wasn't just smart, it was American. It meant you made it. Renting was for losers. The ads made sure everyone knew it. Mortgage applications doubled, then tripled. Banks that once demanded 20% down now offered 0 down. The gold rush had officially begun. Then banks discovered a gold mine: subprime mortgages. Loans to people with bad credit, no savings, and 0 ability to repay. Perfect customers. Banks even invented the ninja loan. No income, no job, no assets. No problem. If you had a pulse, you qualified for a $400,000 house. And because everyone was buying, prices exploded. In some cities, house values doubled in just 18 months. It felt like free money forever. A school teacher bought 3 condos. A barista owned 2 apartments. A parking lot attendant had a portfolio. This was totally normal now. 2005, nobody wanted to live in these houses. They just wanted to flip them. Buy for $300,000 today. Sell for $600,000 in 6 months. Easy. Where were the regulators? The watchdogs? The people whose entire job was to stop this? Asleep. Literally asleep at the wheel. Some economists screamed warnings. A few brave analysts called it a bubble. They were mocked, fired, or simply ignored. The party continued. Wall Street looked at millions of risky loans and had a brilliant, evil idea. Bundle them all together and sell them as one investment product. Imagine taking 1,000 bad sandwiches, grinding them up, mixing them together, and selling the result as a gourmet meal. That's exactly what they did. But who decided these bundles of garbage were safe? Rating agencies, companies paid by the very banks they were supposed to honestly evaluate. It's like hiring a food critic, telling them they only get paid if they give you 5 stars, then asking them to review your rotten food. Obvious problem. Not satisfied, Wall Street took those already bundled packages and rebundled them into CDOs, collateralized debt obligations. Layers of lies on top of lies. Banks in Norway, pension funds in Japan, teachers' retirement accounts in Ohio. Everyone bought this safe product. The world was infected. But a tiny handful of investors actually read the fine print. They saw the rot. And they asked a dangerous question. What if we bet against this? They walked into Wall Street's marble offices and said, "These loans are garbage. We want to bet against them." Wall Street laughed, then took their money. Wall Street created credit default swaps, insurance that pays out if the loans collapse. The catch? You didn't even have to own the loans to buy the insurance. The whole system was a Jenga tower. Every block, a bad mortgage. Every layer, a bigger bet. Every player, convinced it would never fall. It always falls. Meanwhile, Wall Street threw record bonuses. Average banker bonus in 2006, $190,000. The party was loud. The basement was flooding. Nobody checked. Richard Bowen at Citibank flagged fraud internally. His warnings went nowhere. He was sidelined. The machine was too profitable to stop, too greedy to pause. Late 2006. For the first time in years, housing prices stopped rising. Just stopped. Nobody panicked yet. But somewhere, a clock started ticking. The trap was always in the fine print. Adjustable rate mortgages started resetting. Monthly payments that were $900 suddenly jumped to $2,400. Overnight, hundreds of thousands of families missed their first payment. Then the second, default notices flooded banks. The subprime dominoes began to fall. Banks tried to sell their mortgage-backed securities. Nobody bought. They marked them to market value. The value was zero, then lower than zero. Panic. June 2007. Bear Stearns' two hedge funds, packed with CDOs, collapsed completely. $1.6 billion. Gone. The first domino had fallen. The world barely noticed. Banks started whispering to each other, "Do you have hidden losses?" The trust evaporated. If you didn't know what your neighbor held, you stopped lending to them. By early 2008, home prices were falling 20%, then 30%. Houses worth $400,000 in 2006 were worth $220,000. Owners owed more than the house existed for. Wall Street was desperately trying to sell toxic assets to anyone. Overseas banks, insurance companies, pension funds. But the music had stopped. Nobody was dancing. September 12, 2008. Friday night. Lehman Brothers CEO Dick Fuld was on the phone begging for a buyer, a bailout, anything. The silence was deafening. Monday, September 15, 2008, 1:45 a.m. Lehman Brothers filed for bankruptcy. $613 billion in debt. The largest bankruptcy in American history. By breakfast, the world had changed. Within hours, markets worldwide went into freefall. Tokyo, London, Frankfurt, Sao Paulo. The shockwave traveled around the entire planet at the speed of light. Credit markets froze solid that morning. Banks refused to lend to each other. The economy's circulatory system just stopped. Like a heart attack on the entire financial world. AIG had sold $440 billion in credit default swap insurance. Now it all came due at once. The U.S. government faced a choice: bail them out or watch the global economy die. Washington Mutual had $307 billion in assets. Regulators seized it in a single afternoon phone call. The biggest bank failure in U.S. history. Handled like a parking ticket, ordinary people started panic withdrawing their savings. ATM queues stretched around blocks. Is MY money safe? Became the question on every American's lips. Companies had no access to credit. They couldn't make payroll, so they fired people. 8 million Americans lost their jobs in 18 months. 8 million real people. Unemployment offices were overwhelmed. Lines went out the door and down the block. People who had never needed government help, waiting hours for a form. By 2009, 1 in every 45 American homes received a foreclosure filing. Entire neighborhoods went from families to ghost towns in months. The stock market fell 57% from peak to bottom. $11 trillion in 401k retirement savings evaporated. People who planned to retire in 2009 had to work until 2019. Food banks ran out of food. Soup kitchens expanded to 3 shifts. Child hunger doubled. This wasn't abstract economics anymore. This was people not eating. Iceland's entire banking system collapsed in 3 days. Ireland needed an IMF bailout. Spain's unemployment hit 27%. The American mortgage crisis had become a global plague. Even the American car industry collapsed. GM and Chrysler, symbols of American industrial might, went bankrupt within months. 1 million auto worker jobs at risk. Between 2008 and 2010, suicides increased by 5,000 per year above baseline. The financial crisis killed people. That number rarely makes the headlines. By late 2009, Goldman Sachs paid $16 billion in bonuses. The same year, 3 million Americans lost their homes. The same year. Let that land. October 2008. The government had one choice. Let the banks die and take the entire economy down, or bail them out with $700 billion of taxpayer money. They bailed them out. Citigroup got $45 billion. Bank of America got $45 billion. AIG got $182 billion. The same banks that created the mess got the biggest rescue checks in history. Fed Chairman Bernanke invented quantitative easing. Fancy words for, we will print trillions of new dollars and buy up all the toxic assets. Creating money from nothing. March 9, 2009. The Dow hit bottom at 6,547. Then slowly, painfully, it started climbing back. Wall Street recovered. But Main Street's recovery took almost a decade. GM and Chrysler received $80 billion in government loans and declared bankruptcy simultaneously. the government essentially nationalized two of America's biggest companies. Temporarily final score, 26 million jobs affected, $19 trillion lost. 0. Major Wall Street executives prosecuted. 0. Not one person in handcuffs for the worst financial crime in modern history. September 2011. Thousands occupied Zuccotti Park, New York. Fence, drums, cardboard signs. We are the 99%, a slogan that captured everything wrong in 4 words. Occupy spread to 951 cities in 82 countries. London, Sydney, Tokyo, Frankfurt. The anger was the same everywhere. The rich broke it, the poor paid for it. Congress passed the Dodd-Frank Act in 2010. 2,300 pages of new financial regulations. Critics said it was either too much or not enough. Both were probably right. Millennials who graduated in 2008 to 2012 earned 10% less than previous generations for the first 10 years of their careers. The crisis permanently bent their financial trajectory. By 2012, a generation had watched homeownership destroy their parents. The homeownership rate fell for 12 straight years. The American dream took a long, long nap. Lehman CEO Dick Fuld made $500 million between 2000 to 2008. After Lehman collapsed, he quietly retired. $500 million richer for destroying his company and the economy. The rage from 2008 never fully went away. It morphed. It became Tea Party anger, then Occupy, then Bernie Sanders, then Trump. 2008 changed American politics forever. By 2015, banks were lobbying to weaken Dodd-Frank. By 2018, they'd succeeded in rolling back key provisions. History, apparently, is a loop, not a lesson. 2008 revealed something permanent. The financial system isn't a natural force like weather. It's built by people, which means it's built with their flaws, greed, and blind spots today. Millions of Americans have emergency funds who didn't before 2008. Read loan terms carefully. Question too good to be true. Crisis built hard-won wisdom. Use it. Final numbers. 8M jobs lost. 4M homes foreclosed. $19T wealth gone. 0 executives jailed. The math of the greatest financial crime that wasn't officially a crime. The next crisis won't look like 2008. It never does. It'll look harmless, profitable, inevitable, right up until the moment it isn't. That's the only guarantee. If 2008 taught us one thing, in a world run by complex systems, the most powerful tool you have is understanding how they actually work.